welcome everyone to the Institute for Corporate Governance and Ethics Fall 2025 Speaker Series. I'm Todd Haw, Associate Professor of Business Law and Ethics at the Kelley School and the Faculty Director of the ICGE. And you may notice that we are not in our normal studio today. Our Jellison studios at the Kelley School had a little bit of a tech glitch, so we're doing this fully online. But fear not, we're going to have a great discussion today. Even though we're in a new location, and that's because we're going to be talking to Professor Murillo Campello, and our talk today is going to be moderated by my colleague, Professor Luis Ricardo Cabash. And so he's going to introduce Murillo in just a moment. But before I turn things over to Luis, I'd like to say just a quick word about the ICGE. The Institute for Corporate Governance and Ethics was relaunched a year ago with the aim of taking a broader, more interdisciplinary and more systems-based approach to corporate governance and ethics research. So not only did we want to ensure that we were considering corporate governance in its full scope, which includes the areas of finance, management, corporate law, corporate compliance, business and behavioral ethics, and financial controls, but we also want to make sure that research was more accessible to business practitioners. So as part of that relaunch, the ICGE brought Ethical Systems, which is a consortium of business and behavioral ethics scholars, to the Kelley School, which doubled the number of our faculty affiliates and created an entirely new network of collaborators under the ICGE umbrella, as well as a number of new platforms to reach business leaders. So by bringing the ICGE and Ethical Systems together, we've created a one-of-a-kind institution that is able to harness the best academic research to aid scholars, policymakers, business leaders, and students in elevating corporate governance and ethical business practices in their organizations. So this speaker series is just one of the ways that we're doing that. So please check out our websites and LinkedIn for new initiatives and activities coming from the ICGE and Ethical Systems in the future. And so now let me introduce the moderator for today, my colleague, Luis Ricardo Cabash. Professor Cabash is a clinical associate professor of management at the Kelley School in Indianapolis. He also serves as the ICGE's research director for management and finance. And Luis's research focuses on corporate governance, strategy, and international business, examining how ownership structure, boards, and institutional environments influence firm behavior and performance. So his work pays special attention to governance challenges in emerging markets and family-controlled firms, exploring how governance mechanisms adapt to economic and institutional transformations. So before joining Kelley, Luis had academic appointments at the University of Navarra in Spain, University of Sao Paulo in Brazil, and the University of Adelaide in Australia. His research has appeared in leading journals, including the Journal of Banking and Finance, Socioeconomic Review, and Family Business Review, as well as in editorial volumes published by Oxford University Press. And prior to his academic career, Luis worked as a management consultant with Arthur Andersen and Capgemini, advising multinational firms on strategy and organizational transformation. And with that background, he is able to bring to his research and teaching a global and practice-oriented perspective, bridging academic inquiry with the realities of corporate governance, exactly what we are trying to do here at the ICGE. So Luis, with that, thank you very much for moderating today, and please introduce our speaker.
Thank you very much, Todd, and glad to be here with you today and Murillo. Our speaker today is Professor Murillo Campello, a leading and internationally recognized scholar in the fields of financial economics. Professor Campello is the eminent scholar in finance at the University of Florida, where he holds the Joe B. Cordell Eminent Scholar Chair at the Warrington College of Business. He currently serves as the managing editor of the Journal of Financial Intermediation, and he is also a director of the research at the Judge Business School of the University of Cambridge and distinguished scholar at Pembroke College in Cambridge. He's also a research associate at the National Bureau of Economic Research. Professor Campello's work has contributed to shaping our understanding of the relationship between corporate finance and real economy. His research has been cited by the Federal Reserve Chairman, referenced in congressional hearings, and included in the economic report of the president. and even used as an advice to the US Supreme Court. His analysis of the financial impact of the financial crisis, the Brexit, and COVID-19 have been featured in the Financial Times, Reuters, the Wall Street Journal, and other global outlets, as well as in books and policy discussions around the world. Before joining the University of Florida, Professor Campello held the Durland Chair in Finance at Cornell University's Johnson Graduate School of Management. He earned his PhD in finance from the University of Illinois, a master's degree in business administration from the Pontifical Catholic University of Rio de Janeiro, and a bachelor degree in economics from the Federal University of Rio. Today, Professor Campello will present his paper titled Tax Incentives and Venture Capital Risk-Taking, co-authored with Guilherme Junqueira. The study provides a new insight into how fiscal policies influence entrepreneurial finance, affecting risk-taking behavior and innovation in venture capital firms. This paper has already drawn significant attention in our field. It recently won the Best Paper Award at the 32nd Finance Forum in Spain last summer. Welcome, Murillo. Congratulations on these achievements, and thank you for joining us today.
Thank you, Luis Ricardo. Thank you, Todd. Happy to be here, my first time presenting to you today. And let me start by sharing my screen. That's always a technological challenge for most of us, but I hope you can see it.
Yes.
You can do it. Okay, so give me just a second. Okay, so without further ado, this is work I'm doing with a PhD here in Florida. I just moved to University of Florida. I have wonderful PhD students to work with. And what we're doing here is, as you provide a synopsis, is trying to assess the impact of tax incentives, especially tax subsidies, on what venture capitalists do in selecting and keeping the firms that they do. So it is common to see everywhere this idea that tax policy can be used to promote entrepreneurship, promote innovation, young firms in the economy. That's very important. I can show you here, several countries, examples where there is some sort of benefit, some sort of subsidy when entrepreneurs want to start new businesses, especially when they're young industries and have R&D loading into their ideas. Now, the interesting thing is that most countries, nearly all of them, they have this idea that tax policies must revolve around giving subsidies directly to the solo young firms, idealistic entrepreneurs, and that's all fine and good. The US, though, is a different market. Okay, so in the US, we do have a well-developed entrepreneurial equity market. The tax incentives that you want to give to the government wants to give to innovation and entrepreneurship is usually intermediated and in a way captured by actors in the space, venture capitalists, angel investors, and sometimes even the VC arms of corporates as well. Okay, so these are not solo investors, solo entrepreneurs, but instead they are portfolio investors, right? So they have many multiple investment opportunities, not just the one company you run, but instead they have a collection of firms. And so what they do is to combine risky capital with screening and monitoring and some degree of governance as well. So it makes them different than just giving incentives to or tax breaks to, if you will, to a solo individual entrepreneur, small entrepreneur. So the question that we have here, the primary question, I'll refine it as we progress, but the basic question is, will providing tax subsidies to investors that have high risk tolerance and sophisticated capabilities, that be VCs and angels, etc., will that increase the amount of funds going to small firms, new ventures, innovation, or would that just essentially increase the returns going to those intermediaries and perhaps their appetite for taking on risk? Right? So it's a great policy question. We want to help new firms and entrepreneurs and innovation. That sounds wonderful. And one way to do it is through tax policies, through tax subsidies. But what are we going to achieve in a space where the entrepreneurial equity market is well organized and controlled, if you will, by some well-endowed agents? Okay. So let me put a negative side twist to the idea of sending money to, giving tax subsidies to these innovative firms. And I'm using completely here now a US context. So this does not apply to other countries. So what you see in the US is a media, let me call it media skepticism, right? So you see companies going, IPO, doing incredibly well, and many times paying very little in terms of taxes. Okay, I'll explain to you later how this works. But essentially, one could say, by looking at firms that did well, that, well, perhaps they should have paid more taxes to begin with. We should not have given them so many subsidies. So that's one view. Now, if you consider the side of the investors, though, you'll find a lot of statements like the one I want to read to in a second by a billionaire investor, Alan Patricof. The idea is that they must be rewarded also for the losses that they encounter, right? So it's too easy to just focus on the success stories and say, well, that firm should have paid more taxes to begin with. How can billionaires go out, leave a company in the IPO process, for instance, and pay no taxes? So little, snippet what he said recently in a recent interview. Billionaire investor Alan Patricof, co-founder and chairman of Greycroft and Apex, big player. He said, just look at how startups have increased in the last few years. A lot of it is due to QSBS. I'll explain what that is, which encourages people to put money into startups with a very high loss factor. I think it's a non-scientific way of just saying risky firms that may go belly up. So in the analysis I'm going to show you today, in the sample, it'll be an empirical analysis, we'll have firms in our sample. Some of them are here for you to appreciate, right? So firms that you know and can relate to, right? Duolingo, Uber, Zoom, Coinbase, Lyft, WhatsApp, Coursera, Snapchat. Those are firms that are so-called unicorns. They achieve the $1 billion valuation. And if you look into the taxes paid through the process of them becoming unicorns, if you will, you would potentially say that they paid little taxes. On the other hand, what you may not see in the press, but are in our sample, are firms like this. Okay, so these firms were firms in which there were investments, in excess of $100 million, and they all flopped, right? They all went belly up for one reason or another. Some of them due to a lack of good governance, right? I think MoviePass is a company you can relate to, although these firms all failed. And Theranos also a company that was high profile problems with that firm, right? So, the point is to say that, for, so to speak, every unicorn, there's also a big flop, right? And some of these initial investors are bearing the risk of doing business in this space. So what do we study in this paper I'd like to talk to you about today? So we study essentially how tax incentives, subsidies, affect investment in entrepreneurial markets, right? So the point of the paper is to inform tax policy, right? So we're going to ask specific questions about the space. So how tax incentives not only affect the level of investment in startups, but also investors' willingness to invest in riskier ventures, right? So it's not only more investment, but what is the profile? What is the risk profile of these new investments, if any, right? So in the process to identify how this works, I'll be looking to how the responses, right, of incentives, how it varies across organization structures and incentive schemes, differential ones that exist across investors in this space. Okay, so just to give you a clear example, in this space, VCs are the leading vehicle, and VCs, venture capital funds, they combine outside capital, right? They're funded by the LPs, and incentive-based compensation, and compare it to angel investors that typically invest their own capital, right? There's no outside capital. All the structures today are a little bit blurred, but the classical classification would be VC funds, outside investment, outside capital, and incentive-based compensation, and angel investors with investing their own capital. Okay, so throughout mechanisms, tax incentives operate when the same incentive hit these two kinds of investor organization. Do tax incentives affect project selection? One question. Do they also affect how the investors keep and engage with their portfolio firms over time? So that's where the angle of governance enters a little bit in that space. Okay. So what we're going to use in this paper to clarify all these mechanisms is to use a model, which I'll go over very, very briefly, and incredibly detailed data on investor firms' relationships and understand how taxes affect these relationships, okay? And especially the risk-taking behavior of the investors. Now, before I go there, I need to characterize in detail a significant tax program that we're going to use to tease out these effects, right? So there will be some econometric rigor that I need to use, and I'll show you later on. Everything is going to be motivated by a little model, a little framework, frame of mind, if you will. But before I go there, I want to talk about a concrete tax policy that program that's taking place currently right now in the U.S. Okay, so that is the QSBS program, the Qualified Small Business Stock Program. What it does is to provide capital gains tax subsidies, believes, at the federal and state levels. Okay, so it works under Section 1202 of the Internal Revenue Code, and the idea of the QSBS is to give favorable tax treatment that favor, the subsidy varies over time, but to stocks meeting for investments in stocks meeting the following criteria. First of all, the stocks must be issued by C corporations with total assets below $50 million. They have to operate in specific sectors. I'll list later the sectors, but think about tech, biotech, and certain manufacturing firms, and not allowed that does not apply to financials and services and real estate. You have to hold the stock for 5 years to get the benefits that comes under the QSBS program. And what are the benefits? One will see the letter of the law. It is the maximum of 10 times the initial investment or $10 million per person that invests in the startup. Okay. Now, I'm going to make the case just verbally here. I cannot take the time to do it in much detail. Essentially, there are many strategies used by investors, advised by lawyers, that help you pay essentially close to zero taxes in most circumstances. For instance, if you split, a strategy called stacking, if you split the original shares across all members of a family, put it on a state, each person qualifies for a $10 million tax exemption. So you quickly multiply it by 50 members, you get the idea. And people do that. Okay, so what is the idea? What exactly is the benefit? Give me some numbers, Murillo. So at inception, the QSBS program, the idea was to cut in half the federal tax gain rate of 28%. Right? So half of 28% is 14%. Right? Now, as the capital gains tax rate dropped to 15%, right, the net benefit of the QSBS became just down to 1%. Okay, so 15 minus 14, 1%. So it wasn't appealing for a number of years. Okay, it was not an appealing program. So let me graph here the evolution of those numbers, right? So the capital gains tax rate declined in the US from 1993, when it was 28% when the program started, down to about 15% by 2010. The QSBS benefit stayed constant at 14%. Therefore, the net benefit went down to 1%. So QSBS, not exactly appealing. Now, came the financial crisis, and a couple of acts in Congress, the American Reconstruction and Reinvestment Act and the Small Business Jobs Act from 2009 and 2010, change the benefit implied by QSBS, essentially by allowing a near, there's some details, everything's complicated, but there's near tax exemption for companies, for investors investing in companies that qualify for the QSBS program. Now, you have to invest in them for at least 5 years. So if I put in what it means in the new numbers for the benefit, essentially firms that were invested in a QSBS program after 2009 and 10, and for investors that exited after 2015, they essentially paid close to no taxes on their gains. Okay, there are some caveats to that, and I should emphasize, but I need to have a simple graph, and this is a simple way to characterize what's happening here. Now, as is the case in the US for many things that pass in this country, there is heterogeneity in the way, differences in the way how states conform with the law, right? So at the federal level, the graph I just showed to you applied fully. But of course, you pay, as an investor, you pay capital gains taxes both at the federal level and at the state level as well, right? So how did states respond to this to this innovation of QSBS enhancement? Most states conformed 100% with the federal guidelines, providing the same tax benefits. Now, a number of exceptions are still, in play though. So important states like New Jersey and Pennsylvania and Alabama and so on, even Massachusetts, did not comply with the federal mandate. They provide no tax benefits. And interestingly enough, an important state in our sample, California, where most VC companies are located, used to comply with the mandate, but then a local judge, federal judge, decided that was unconstitutional, and it reversed its compliance, means that California no longer abides by this the QSBS program. Okay, so the point is to say that if you look across states in the US, there's a lot of variation regarding compliance. And it's important because some states have low tax rates, local state level capital gains tax rates, such as Texas, which is 0%. So for those states, complying or not complying does not make a big difference. But other states, such as California, for instance, where capital gains tax rates were 14% in 2015, complying or not complying makes a huge difference, right? It kind of essentially doubles up the tax benefit if your state complies with the federal mandate, right? If it doesn't comply, then it's a big loss for you, provided that your state has a big capital gains tax rate to begin with. So I'm not going to get into the complications of across state differences, but it's very, very interesting. And it helps us in our analysis differentiate different channels of the impact of taxes on risk taking, which I'll not discuss today, but I'll just invite you to think about how these differences across state also have implications for any policy mandate. Now, how can we say in finance terms that it may be the case that the tax incentives, tax policy, tax subsidies may help or may prompt some investors to take on more risk? So to do that, I need to do a little model. I'm not going to spend a lot of time on this, just a couple of equations, actually just one equation and one big figure, try to convey to you why is it that venture capitalists, the way their venture is, the fund is set up, may provide them with incentives to take on riskier ventures when there is a tax subsidy. And that's important because riskier ventures oftentimes are those that have more innovation capabilities or potential in there, as well as the likelihood of failure. So in the model, which I'll just kind of give you an overview, we have VC investors, venture capital investors, the way you know them, angel investors, and corporate investors, right? So corporate VCs, right? So these vehicles account for about 80% of entrepreneurial funds going to QSBS eligible firms, right? So remember, QSBS, small, and you have to say invest for 5 years, and they have to operate in some sectors. I'll be more concrete in a minute. Right? So these vehicles, VCs, angels, and CVCs, are very different when it comes down to how they fund themselves and how they are taxed. Okay, so the model we have will explore all these differences, and essentially we'll see what would happen to their payoffs and risk-taking behavior if they all were to invest in a firm that has to be modeled somehow, a firm that has a process, a cash flow process, we're going to call it X. I'll come back to this X thing in a couple of slides. We'll show you a graph. And X is a cash flow process. It has some average return to it, if you will. That's the mu there, and some volatility. That's the sigma. Okay, so the addition, the innovation in modeling this process here is that we also have what we call sudden deaths, where firms sometimes can go out of business very quickly, and so we call it sudden deaths. All right, so so we have in the model three parties investing in the model: VCs, angels, and CVCs. The focus is really on the VCs, okay, so that they drive most of the results in the model, in the paper, in this analysis. So they have a very specific organization structure and payoff profile. And the way they work is something like the following, right? So make it very simple. In the VC fund, the GPs, general partners, they make the investment decisions in the startup company using the funds of the VC fund after getting those funds from the LPs, the limited partners, right? So the venture is the VC venture. It's led by the GPs, who essentially use money from the LPs. So there's a lot of a large case to make reasons to make a case for why the GPs, the people in charge, may take on risk. Okay, so the reason being essentially from financial modeling perspective is that the payoff profile of those investors it is very much like a call option payoff profile. It combines four interesting features that I'm sure you understand how how interesting it is. Okay, first of all, they use outside funding, right? So commonly, nearly 100% of the investment funds come from the LPs. Again, the GPs make decisions with money from someone else. That someone else is the LPs. There's a management fee, so the GPs make 2% of the investment funds. And there is something called a carried interest, which is commonly 20% of the profits of the fund, profits that surpass a hurdle rate. And this hurdle rate is about, say, 8%. It can go from 0 to 8%, right? So the point to say is there's this leverage, multi-layer leverage payoff profile, right? Condition on this and condition on that, then the VCs, the GPs get some money, right? So I'll make the case, just verbally here, that when you have this very convex payoff profiles, typically it is good for you making the decision, the investment, to take on riskier propositions, riskier ventures, because you do not share the risks, okay? If things go well, profits are yours. If they go bad, losses are put onto someone else. But there'll be also a case against taking so much risk, right? There are reputational costs, right? For GPs to raise funds tomorrow, they better have done well today, so they cannot just take on too much risk. There is the issue of co-investment. Sometimes the funds require that the GPs themselves invest some in the fund, so they put some skin in the game. And startups are very risky to begin with, so you have to be careful about investing in startups as a whole because they fail oftentimes for reasons that you do not understand. So they're extremely risky propositions to begin with, so we need to be careful. And the GPs have a more undiversifiable risk than the LPs. Okay, so essentially the GP fund has 12, 15 portfolio companies, so the GP has to be very careful. Only 12, 15, whereas the LPs have a larger menu of investment opportunities and channels, and they don't care necessarily so much about this or that company not doing well. So the model goes down to comparing this with the profile of the angels payoff profile, which is linear in the company's cash flows. The angels get, whatever percentage of the firm's profits. And the corporate arm of VCs, they are exposed to corporate income taxes, not to capital gains taxes, right? So we use that as a baseline comparison as well. They're also VCs, but they do not pay capital gains taxes. So therefore, they're not affected by changes in the QSBS program. Okay. So what we do, just to give you a sense as to where we're going empirically, we calibrate a model where all these elements come together. And the big punchline of the model is to say that tax subsidies increase risk taking in new investment selection in general, but especially for VCs. Okay, so this is due to their option-like payoff profile that combine outside capital with carried interest. Essentially, someone else is paying for this. I will, take on riskier ventures. Even if I account for reputational costs, co-investments costs, and what we call sudden deaths. Okay, so to put it formally, if I were to just a quick equation here, or what I'm going to say and show through a graph is that the demand elasticity of new investment to taxes for riskier projects. I know it's a mouthful here, but that's the demand for investment with respect to taxes for riskier projects, that's what this first half says here, is higher for VC investors than it is for angel investors. Okay, and to show this graphically, I modeled this with real data using a discount rate and profit rate that comes from the literature and the evidence. And I arrive at this beautiful figure, the last thing I'm going to show you on the theory today, where I compare the investment risk profile of VC funds with angel investors. So what am I learning from this picture here? As you can see, they're very different. So I'm analyzing a three-dimensional space, which is always complicated. But what I have here, the main variable, main surface that I want to care about here is when does an investor decide to invest on a venture? Okay, so a higher X, remember I talked about X a few minutes ago? A lower X means the investor is more likely to invest in such venture. So this here just says the following. When taxes are lower, and taxes is what I'm looking at on this space here. So taxes may go from 40% to zero. Lower taxes trigger more investment. Okay, I get that. Makes sense. Now, what's interesting is what happens as we travel, as we think about the riskiness of the investment proposition. So as we move on this last surface here, okay, this side here. So if you're looking into what happens to angel investors, there isn't much of a response, of a difference, how these investors react to the risk of the project. So those lines are essentially parallel lines here. When I look into venture capital funds, on the other hand, so we'll go back to the first graph, there is this surface, this decline in this curve here, which essentially says that venture capital investors are especially sensitive to tax breaks, to tax subsidies, when the ventures they invest in are riskier. Okay, so the combination with lower taxes and risk make venture capitalists more willing to invest in ventures that provide them with that profile, that exposure to more risk. Okay, it's more profitable for them to do so. There are more incentives to do so. And that's what we're going to test in the data. Essentially, does the QSBS program prompt investors, especially venture capital investors, to look for portfolio firms that present a profile that is riskier, that seems riskier. Okay. So what kind of data are we using here? We're using data from PitchBook. It's a fairly new data set that tracks data from VC, angels, and corporate arm investments, VC investments. They are gathered from cross-checking data from LPs and GP reports and web scraping and Freedom of Information Act efforts, different sets of sources here. And the idea at the end of the day is that we observe each investor-firm relationship, okay, from initial investment to valuation milestones, such as when they become a unicorn, all the way to exit choices, such as do they go IPO? Are they acquired? Are they do they fail? Right. So with this data, we can get information from 39,000 investors and 35,000 portfolio companies. When you put them together over 20 years, we get pairings of 158 investor firm level pairings. Okay, so a lot of information there, a lot of marriages and separations that we can look into here. Okay, so just an example, data from Uber, right? So we have information from the early lead investors, and when the firm exited, in this case, it went IPO 2019. Same for Lyft, WhatsApp, and companies that you know about. They have different starting points and different games. Some became LBOs, some went bankrupt. But the point is that they're all under investments made by investors made by by VC, mostly VC vehicles after the change in the law and the tax benefits I discussed. Right? What kind of firms we have here? So and type of investors. So venture capitalists dominate the sample, about 47%. Angel investors are there as well. What is the exit type profile? Acquisitions and going private, being bought by private equity, some IPOs, but a lot of exits such as business failures. That's the other category there. And what are the eligible programs? I'm sorry, segments under the program. Industries such as technology, biotech, industrial manufacturing. Non-eligible would include commercial services, banking, healthcare. Right? So you have an idea of who invests in them and what are the segments that qualify for the program. If I put together a profile of investment in QSBS eligible and QSBS ineligible sectors, I have something like this graph that I show you here, right? And the idea of this graph for empirical testing purposes is just to show that there is no concentration of a investor type on an industry. So for instance, it's not the case that technology is dominated by VCs and say hospitality is dominated by corporates, right? So the idea is to show that this graph looks to be repeated over and over again across different industries. So there's a good balance in a way that different investors invest across different industries. So let me summarize to you very briefly the testing approach. I'm not going to show you any tables, but I will talk about final results. What are what can you read from the tables that I will meet to you today? What's the testing analysis approach that we're going to use here? First question we ask is, do investors strategically time their exits to qualify for this QSBS tax subsidies, right? If they are so important, investors will probably they'll probably try to cluster around investment horizons of 5 years to max out the benefits of the QSBS program, right? So we'll do something that's called econometrically bunching, a bunching analysis. I'm going to show a graph later. The idea is that we'll look into firms that qualify after the program has an enhancement. So that meaning they're small and they in the right segments. There should be a bunching, be a lot of investments that exit from those firms at exactly 5 years investment horizon. Remember, we know the duration of the matching, of the marriage, if you will. Well, then we do an analysis. That's all well and good, but a more careful analysis would consider not only what happens after the program enhancement, but also what used to happen before the program enhancement, meaning before 2009, when the benefit was, you may remember, just 1%, was very small. So make that comparison. And for fun, we'll compare in the post period again, what happens to QSBS eligible firms and ineligible firms. Okay, and even go to the extent of comparing after the program QSBS eligible firms with before the program QSBS ineligible firms. We call it placebo tests. Then the second out of 3 tests is ask, do investors strategically allocate funds towards firms that are QS eligible firms, right? So you may remember that I talked about the fact that one of the conditions for benefiting from the program is that your firm has to be, the total assets have to be lower than $50 million, right? So we call them the treated firms, right? So if you qualify for the program, your firm is below $50 million, we would say probably there is more investment in those firms than investment in firms that are very similar, same industry, same everything, but above $50 million. We call it regression discontinuity design. And we also do what's called a difference in discontinuity, which is to say that we do this analysis before and after 2009, before and after the enhancement of the QSBS subsidy. The last set of tests, I'll just explain what we do here, is to look into, it's going to be a differences in differences analysis, where we're looking to before and after the enhancement of the program, before and after 2009, whether firms that qualify for the program, whether the investment profile in those types of firms becomes, say, riskier in ways I'll define soon, compare that to what used to happen before the program enhancement. So, comparing after 2009 with before 2009. Looking here only at QSBS eligible firms, if you look at the first half of this picture, if you compare as a baseline QSBS ineligible firms, firms that are not treated, they are placebo control firms, will have this what's called a differences and differences analysis. And the final one twist to this is a triple difference to make things as detailed as we can, because the data is so interesting. We'll look into whether or not the investment was held for 5 years or more, right? So you have to hold, again, the stock in a particular sector of a specific side, less than $50 million, and for 5 years or more. That's where you fully benefit from the program. Okay, so all of these tests will apply to the data. The idea is to identify risk-taking, to see if this program actually leads to any changes in investor behavior. So the first thing we do is the bunching analysis, which I'll show you in a very simple way here. So essentially looking to whether investors are more likely to hold their investments in QSBS firms for more clustered in 5 years after the program enhancement. And so I have the distribution of holdings by VC firms on QSBS eligible portfolio companies before the law enhancement, the tax benefit enhancement. You see this almost flat distribution, nothing special about 5 years. But after the passage of the QSBS tax enhancement, you see a concentration of investment there, preference for more investment in that segment, 5 years holding period. So we do this in a more, I'll skip quickly here. We do it in a more rigorous manner using a bunch estimation, and we confirm these results here. I'm running out of time. Let me show you something that I think is interesting, which is the idea that firms just below the $50 million threshold are more likely to get money than those firms just above the threshold, right? So we do this comparison here. The focus is on the red graph on the right side, and you see there is a so-called discontinuity, meaning firms just below the threshold get more funds than the firms just above the threshold. Okay, after the change in the program, that used not to be the case if you're looking to the left graph before the change in the program. So the main result of the paper is this one here. We're going to do, as I said, the triple difference analysis. The idea is that we're going to look into measures of risk, which I'll define in the next slide. That's the Y dependent variable here. What happens to risk-taking behavior by firms, VC firms, angels, and CVCs after the passage of the change in the QSBS program? So what happens to risk for eligible sector firms after the passage of the enhancement? So we're going to be focusing on this beta 1 coefficient here. Okay. So what are the results that we get? VCs are 74% more likely to invest in firms and startups in the pre-commercial stage, firms that are early in the development of ideas, 3 times more likely to invest in firms carrying some pre-existing debt, so there's more financial risk to them, 16% more likely to invest in states away from their domicile headquarters, where the headquarters domicile, so in places that are harder to monitor, 6% more likely to enter new industries where they have no previous track record, and 40% more likely to provide the startup firms, first funding, so with less per-certification. Finally, 20% less likely to syndicate their investments, so it's less risk sharing. Okay, so these patterns are unique to VCs, and you do not see the angels or CVCs doing the same, taking the same risks. Okay, let me skip forward for my last result here. I'm going to skip this map. Okay, and the last thing I'm going to do is to add to what I just had there, the diff and diff, one more condition, which is that the firm, the portfolio firm must be held by 5 years or more for the benefits to be, tax benefits to be obtained. Okay, so my last set of results is this here. We do this triple difference. Now it's more complicated because I have the additional condition that the investment must be held for 5 years or more. And what I get from that's my last set of results here, firms that qualify for the QSBS program in the right amount, the right size, the right industries, after the investments hold investment for more than 5 years, what happens in the risk return dimension? Well, there's an average higher return. There's an average, first of all, a higher business failure rate of 71%. 2 times as likely that the firm achieved the uniform status, and now the return, twice as high return rates for the firms that find an exit, right? So when you invest in firms, when VCs invest in firms under those circumstances that fit the program, maximum benefit, you see more failures, more unicorns, if you will, and on average, higher returns. These patterns are, again, unique to VCs because of the reasons that we discussed before in the model, and do not apply and are not observed for other ventures such as angel investors. So to conclude, what we do here is to look into this unique setting where funds going to entrepreneurial firms are intermediated by venture capitalists, angel investors, and corporate arms, VC arms, and they have different structures and incentive schemes. And the point is that we have a model showing that VCs are more likely to take on risk because of their payoff profile and the way they're taxed. And we use this change in it's called the QSBS program to show that tax policy does change the investor appetite for risk differentially across industries, investment size, and timing of investment as well. Okay, so essentially what you see, tax subsidies prompting venture capitalists to fund riskier but also high return ventures, that leads eventually to both higher failure rates and more unicorns. And that's what I wanted to tell you today.
Thank you very much, Murillo. Once again, it's a beautiful executed paper, and I mean, conceptually tight, empirically rich, right? And more than that, it's policy relevant. So before we move to the audience questions, I would like to think of one of the questions that interesting a lot for our audience in the Corporate Governance Institute here is about these implications, right, for corporate governance in this venture ecosystem. So your results shows that if the tax subsidies steepen the convexity of carried out interest, right, it's what you show, they might amplify potential agency conflicts between GPs and LPs, right? So how should limited partners should respond to this result from your model? Do you see an argument, for example, for adjusting fund governance mechanisms to account for that? So what is your thought?
What a great question, Luis. And we looked at it very briefly. I don't have a whole analysis to present to you, but we also find in the paper that VC funds understand their take on riskier ventures, and what they do is they more often change management, have more boards, seats on the boards that they of the companies they invest in. So it appears to be the case that they know what they're doing, and they know they're getting to riskier propositions, and they try to have more control, more governance control over those portfolio firms. Now, the question about the LPs that you have are particularly interesting because one would argue actually that LPs want more risk. LPs like the exposure to risk. They're not the ones complaining about it. We plan to look into another paper where we're looking at the context between LPs and GPs. Here I just use the average format, but maybe there is some variation on the carried interest, for instance, right? And as a response to the discoveries we make in this paper, I have not done that yet, but that's our next step. Exactly looking to how governance issues and conflicts between LPs and GPs may change their contracts.
Fantastic. There is another interesting question from the audience that is about you started framing different mechanisms through which the governments could influence entrepreneurial firms. And one of the questions here, I think it's talking or speaking to this for your first motivation of the paper, right? Are the theoretical implications of your model similar to what would happen if the government gave the funding directly to the entrepreneurial firms?
Great question. So, then they would behave more like in the model. I didn't show it completely. More like angel investors, and for angel investors, right, we have all along in the paper, but I did not talk much about. There are no changes in risk-taking behavior, right? So if the subsidies were given directly to the entrepreneurs, if you will, they would probably not see the results I showed you today. If you can compare them with angel investors, you would not see any of this willingness to take on riskier companies.
So
Another, yeah,
Luis, do
go
you mind if
ahead.
I jump in real quick? Sorry, I
Please,
apologize.
go ahead.
So Murillo, so what do you attribute the difference in the angel investors and VCs? Is it sophistication? Because what's the difference? Because both would seem to benefit from pass-through tax status, and you've got incredibly sophisticated VCs. But also sometimes incredibly sophisticated angel investors, depending on exactly who you're talking about. So I'm just interested in your take on why you see that, or what you think is the difference there.
Speaking of sophistication, a result that I did not show you today is when you have more sophisticated LPs, such as some university endowments, you see even more risk taking, which is kind of interesting, right? But you asked me about VCs and angels. I would argue that angels are as sophisticated as VCs, not every single one of them, but the information they have is what we teach at business schools. It's nothing super special, right? So you can acquire that skill. But it is my results will speak to the way the venture is set up. A VC fund or angel vehicle are very different in the payoff profile scheme, and that is what drives the differences. Not that angels are less sophisticated than VCs. VCs are not particularly highly sophisticated across all dimensions. But there could be some component of sophistication. I cannot rule that out, but it is the incentive scheme, the payoff profile that I think drives those differences.
Interesting. There is another question that I was thinking about. For example, you showed this behavior shifting to or risk shifting because of these tax incentives. How do you how much do we know about the political economy of lobbying origins of these incentives? For example, this National Venture Capital Association, in their website, they explicitly mention that they would like to have more incentives or tax incentives. So do you see that these lobbying activities affect in some ways your results as well?
That's a great question. And, lobbying is hard to observe. I'm sure it's happening. And in a longer version of my presentation, I have pictures of some venture capitalists talking to Obama about that topic back in 2009, visiting the White House and asking for such benefits. I do not know what happened in those conversations, but I'm thinking that lobbying was an important motivation, an important factor here. They got what they want, which is part of the system. There's nothing wrong with it. But it is definitely this change in the regulatory treatment of capital gains taxes probably happened as a result of a lot of heavy lobbying for them. But one could argue, and that's true in the data as well, that a lot of innovation comes about through this channel too, right? It's a risk-taking idea. There's pros and cons.
Some of your prior research has had important policy implications. For example, in your CV, you can see, right, as I mentioned before, different, policies, policymakers being influenced from your research. So if you have to make a policy statement here or an advice for policymakers, just as you just mentioned, right, there are higher risks, but also higher returns. The question now remains who gets the benefits, right? In terms of social welfare, what kind of policy implications do you think that we can learn from this study?
Is a great question, Luis, and I've been asked this question before. And as a scientist, I would say to you that I cannot answer this question without a bigger structural model where I understand the monies, the funds, the taxes that were not paid, what happened to them, what could have happened to them on the counterfactual if they were distributed across other interests of the government, the budget, right? I can't answer this question. I could guess, my guess, looking to my reduced form, as they call it, evidence, is that there is good potential for tax policy to change the pace of investment allocation and risk taking. And something that I haven't talked to you today, but it's in the paper, provide for more investment in innovative industries that have commercial value and add value to market value to the stock markets, if you will. And it's something that I'm skipping today. But I can see a lot of beneficial consequences of what I'm talking about here, but I cannot look into, the alternative use of those funds, right? Maybe those funds should be better used somewhere else in society my paper can't speak to that, right? So I have to stop at some point. Very good potential for good things happening in the private sector, but in innovation, but at the cost of something that I cannot measure.
I see. In terms of the future research that you oversee from these results that you got, for example, you come up with a very strong database, right? And what are the line of research that you're thinking on to answer moving forward that you can, this is a huge project, it seems to be, right? Given the efforts that you and Guilherme has collected. So what is your key questions moving forward that you're
just going forward, as I said, how the funding of these vehicles happen, right? So there's more and more out there. Private debt is being used more and more across the universe of investment. I don't think anyone has looked into the entry of private debt in these markets, in entrepreneurial markets, and it's something that we want to look into. But private debt is private data, meaning we don't have access to it as academics, so it's a challenge. But a lot of growth in today's capital markets in this country towards credit markets that are privately managed. So I think that's one place we're looking to it here. Private equity debt is different than equity, so there are implications that speak to our leverage payoff profiles that I just described today.
Fantastic. So I would like to thank you, Murillo. We are on time right now. So it's outstanding research and work that you and Guilherme has done, and rightly relevant, and it's an ongoing debates that we have in this entrepreneurship finance. So thank you for bringing this research to Cali and the Institute of Corporate Governance and Ethics, and congratulations once again on the paper. recognition from the Finance Forum in Spain.
My pleasure. Great questions, very helpful for us going forward with this analysis.
Thank you.
Great.
I'm going to pass to Todd.
Great. Thanks, Louise. And thank you, Murillo. Great talk and expertly moderated. Appreciate it. So I'll just remind our folks that are listening that we have another speaker coming up next month. So on December 3rd, Zach Sautner from the University of Zurich will be here to talk about some of his work. And hopefully maybe we'll have Murillo back when he completes the next round of papers in this topic as well. So make sure you check out our social media, both websites, Ethical Systems, as well as the ECGI itself, as well as LinkedIn. And until then, we'll talk to you or we'll see you again. Thanks so much for joining us. Bye-bye.